Welcome to Retirement Mentorship. My name is Freeman Lindy. I'm a certified financial planner, and I help folks over the age of 55 retire successfully and stay successfully retired. And today we are going to dig into one of the most popular and flawed investment strategies alive today. And that is target date funds. So many people are invested in these. There's about $4.8 trillion right now of Americans' hard-earned retirement savings dollars in these types of funds. They're called target date funds. They're called life cycle funds, retirement guide path funds. There's a lot of different names for them, but they all basically mean the same thing. And that is a certain type of autopilot investment strategy that is supposed to help you prepare for and then live in retirement, all automated, all low fees, make it super easy for you. And they are dangerous and they have lots of problems. So we're going to dig in today why you should not invest in target date funds and why and a better strategy instead. So let's dig into the way that they work first of all. So you've heard me talk about this before. If you haven't, you can go back and watch a prior episode. Probably the supercharging the 4% rule from a couple weeks ago would be a good example to do. But when it comes to investing, there are a couple of things that you can invest in, right? There are equities or stocks. Those go up and down, up and down, up and down. We'll do about 10% per year, 8 to 12, somewhere in there, right? On average over long periods of time. And then there's fixed income or bonds, CDs, that type of stuff. Those will fluctuate a little bit with the changing of interest rates. Definitely, usually more stable, might do 3 to 5% over time, right? And those are really the main two asset allocation classes that you can be invested in retirement. And so the way that many people think about saving for retirement and living in it is that over time, right? If this is the time when we are going to retire and this is when we start our career, then over time you want to save and invest and climb, up the proverbial mountain, and then you want to spend down the other side, and hopefully you pass away before this reaches zero, right? It's kind of the idea. And so a lot of times people say, well, hey, you want to be right more aggressive, have more equities on the front end as you're young and can let that grow. And then you want to fade that into more conservative elements by the time you get to retirement and can live off that later on. So you don't have the volatility. You don't want to lose things, right? Oh, if I lose 30% of my retirement, I don't have time to earn it back, et cetera, et cetera. And so this is how people tend to think this through. So the way that a retirement or a target date fund plays into this then is they will say, well, hey, we know that you want these 10%-ish returns, 8 to 12, whatever you want to call it. We want some of those to get some growth, but we're going to want some more stability when we get into retirement. And we know people are lazy and they will spend more time trying to figure out what to watch on Netflix than they will on how to allocate their entire life savings. And so how do we make this easy for them? And so they created the target date fund. And the way that works is, again, over a course of a retirement. So let's say this is your retirement year. So this is year 0, right? They're going to basically set 5-year increments going all the way back. And so if this is if you were retiring this year, it might be a 2040, it'd be a 2025 fund would be kind of the retirement, the target date that, hey, it's trying to hit a certain mark on 2025. If you're retiring farther out, you might have a 2030 or 2045 or if you're real young, 2050 or 55 fund, right? And so they're saying, hey, we're going to create funds for every 5-year increments out of these even 2025, 2030 years, right? And the way we're going to do that is we're going to start out on the front end. If we have, kind of a pie chart of how this stuff is invested, we're going to have 90% invested in stocks, right? And we're going to have 10% invested in bonds. And that way you get a lot more of the growth as you earn and as you are younger in your career and going towards retirement. But then about 5, 10, 15, 20 years out or so. So again, if we look at, here's your total 100%. This is a 100% investment here, right? You're going to have 90% of it invested in stocks, 10% invested in bonds, right? up to about, and we'll put some other lines on here so we can make this a little bit easier to see, all the way up to year 0 when you retire, right? All the way up to about there. And then we're going to slowly start gliding this down, right? And we're going to reduce the amount that you have in stocks and increase the amount that you have in equities or in bonds, excuse me. And the idea would be that once you hit your target retirement date, you are at 50% stocks and 50% bonds, right? Some of them just kind of tear it off pretty quick and they kind of do this, stair step it down. Some of them have a nice curve. Some of them are slightly more active and will pick and choose when they do that. It just depends on the exact fund that you have. So then the idea is like, hey, as you get closer, it's automatically going to get more conservative. You switch from accumulation to preservation. Seems like a great plan, right? Okay, couple of problems with this. One, in my opinion, if you are sub 40, right? If you're in your 30s or 20s or whatever else, and you have decades, tens of years to work before you need any of this money, why do we need 10% of your money making 3 to 5% instead of 8 to 12? Why do we need that? We don't. All that does is it slightly reduces your volatility and also then therefore just slightly reduces your return for your whole life. Completely unnecessary. So I guess let's list off some of the problems. So number one, forever less, we'll call it, right? For the whole time, you're going to have 10% invested in bonds for no reason. Number two, too soon. So it starts ratcheting down, like I said, usually most of them start ratcheting down 20 years before retirement, which means that as you get from 10 to or 90% to 80% to 70 to 40 to all the way down to 50% equities, there's a lot, you keep getting more and more of this type of investment that is only making 3 to 5 instead of 8 to 12. And so it continues just to reduce your return, reduce your volatility for sure, but also reduce your return as you get closer and closer. There is pretty much no period of time where over a 20-year period you would be down, right? Or over a 15-year period. Really, the only times I don't know if you've seen any of these, we've talked about them before, but where they'll talk about, hey, the number of rolling 15-year periods, 10-year periods, 20-year periods where the market has been positive, and like what's the percent chance that it's positive? And at 20 years, I think it's 100%, and at 15, it's like 97%, and at 10-year rolling periods, like 85% of the time it's positive, things like that. Really, the only way that you even get these negative ones is you have like 2001 and you have like 2008. If you're measuring from X to here or Y to here, that's when you get some of those negative numbers. If you get rid of these 2008, 2001, mostly just 2008, you eliminate most of the long-term down periods. And if it is down at the end of 15 years or 10 years, and you just wait another year or two, it'll be back up and up in spades. And so really, we don't need it to get this conservative this quickly. You're leaving a lot on the table by doing that. And just to give you an example, if we want to throw that thing up on the screen here, Ethan, we've got the so all the Vanguard funds. Vanguard's a popular fund for this, right? It's in a lot of 401ks. A lot of people invest with Vanguard. We've got the target date 20 fund through 2060 fund, right? And what they've done over the last 10 years, right? And so they still have these 2020, 2025 funds, which basically means you'd be retired now and you still own the fund, and the rest of them meaning you'd still be out. That's right. So the total return over these is from between 90 to 178. It's basically double, right? And so putting $100,000 invested 10 years ago would have gotten you to 190. You almost would have doubled your money over the last 10 years in the Vanguard 2020 fund. But in the Vanguard 2060 fund, you would have almost tripled it, right? That's an extra, what is that? Like an extra $90,000, right? Yeah, like an extra $90,000 over 10 years just by being in a Vanguard fund that has less bonds and more equities than the other way around. And so by ratcheting these down, by getting more and more conservative, the same thing applies to each individual one. You are leaving a lot on the table and you're getting too conservative way too soon. The last issue is, we'll call it no options, right? And again, we talked about this a little bit in the supercharging the 4% rule, but the way that we would teach people, right, is to say, hey, you want equities and you want fixed income. And when your equities are up, we want to pull money out of there. We want to sell high, right? And when your equities are down, we don't want to sell when your equities are down, right? That's the whole point. You want to buy low, sell high. And so we want other money that's just been trunking along that we can sell out of instead. So we'd stop taking money out of here when the market's down, take our income out of our fixed income instead, right? If you've got a balance fund, a target date fund, any of these funds where they combine them into one, right? Again, by the time you're in retirement, you're 50-50. And so you just got one purple bucket. Well, as you pull income out of there, right? Half of it is fixed income and half of it is equities. And so if your equities are down 35%, then half of all the money that you are pulling out of your fund is also down 35%, and you are selling low, the one thing you are not supposed to do, right? You are turning a temporary decline into a permanent loss by being forced to sell something that is down. And so even if you wanted to be 50-50, which I don't think you do, but even if you wanted to, you wouldn't want it in a target date fund that is forcing you to pull 50% out of each, right? You would want to be able to pick and choose which ones you have it. These target date funds are mostly just a combination of a total market fund, an international fund, total bond fund, total international bond fund, right? Like you can actually get the component parts of a target date fund yourself. If you just do like a little bit of work, and there's better ways to do it still, but even that would be slightly better. And so no one in retirement should own one for sure. This is honestly the worst form, the worst place to own them. I don't think anyone else should own them either, because you always have getting less for no reason, and they get conservative too fast. But especially in retirement, if you're over 55, you should not own any target date funds. So your action item for you, right? The one thing that you should be doing, and you could, if you're sitting down watching this, you could be doing this right now. Here's a big check box. Check your 401k / any other accounts. Do you have a target date fund in it? Do you have anything that has, you want to throw that list up there again, Ethan, anything that's got, 2020, 2045, if that has a year number, like one of these years, it is a target date fund. It is a life cycle fund, whatever. They have different names, but it's all the same thing. So that's your homework. Check your account. Do you have one of these? If so, split it out. Get rid of it, right? You could keep the same allocation if you want, just split it into two different funds so that you have the choice of how you'd want to distribute that in retirement. Again, if you're way out from retirement, I don't think you should be taking this penalty the whole time, right? And the whole point of this is that people would sue 401ks when their accounts would go down. And so they said, well, hey, we can't have people suing us. It's not our problem. And so they created these qualified default alternative investments, QDIA, which is, hey, you're by default will go into one of these funds if you don't pick and choose. And since these are set up to automatically get more conservative for you, you can't sue us if the market goes down. And so really they were kind of created as a cover your butt for the industry. And it's a nice autopilot thing. Like, is there worse things you can be invested in? Yeah, you could be invested in just bonds your whole life. That would be worse. And so, right, this is not technically the worst thing you could invest in. But is that what you want? Like, do you want your financial plan to be, hey, what's not the worst thing I could be invested in? No, we want the best things, right? We're not trying to avoid mediocrity or to attain mediocrity. We're trying to get the best of the strategy. So, and there's no point where target date funds are in the best strategies that you can have. So for all these reasons, you should not own any target date funds. Check and see where they are. You can split them into component parts. Go watch the Supercharging the 4% Rule episode, and you could see a little bit more how we would do it. And of course, if you want help with it, you're like, I don't know about all this. That's what we're here for, right? So you can schedule we do a couple meetings for free with everyone just to see what can we do for you. Here's what we can do for you. I think there'll be a link in the description if you want to schedule that. Otherwise, certainly you don't want to be anywhere near a target date fund, even though it is the default and the thing that everyone loves to do. So it's part of my secret mission is to go out and get people get that $4.8 trillion out of target date funds and into a more intentional strategy. So, and lastly here, if we can throw up this the screen that I'm sharing. There we go. Perfect. So here we have a Vanguard Total Bond Fund, which is this blue one. Over the last 20 years, hasn't done much. Went from 100,000 to 184. So it hasn't even doubled in 20 years. We've got the total stock market fund from Vanguard, which is this green one. And then we've got the 2025 target date fund, right? You'll see that early on in this period, it actually stuck closer by, right? Because 20 years ago, it was more, had more in equities. So when the market went down for 2008, it followed that more closely and bonds maintained a little bit better, right? But ever since that, it catches in and like, right? Obviously, if you have a 2025 fund that's got some of each in it, it's going to just split the difference and go in the middle here, right? And so, right, did we lose less in 2000 and 2021 between the target date fund and the equity fund? Yes, we did. We lost less, but we also had way less to begin with, right? And in the end, over the last 100 or over the last 20 years, if you invested $100,000, your bond fund would be worth 184, your target date fund would be worth 363, and your total stock market fund would be worth 734, right? Literally over twice as much. So that's why we just don't want to do it, right? Like if you were trying to retire this year and you just been all equities, you would have had literally double the money over being in a target date fund. Now, you wouldn't want to go into retirement with just the total stock market fund. But that just gives you an example of the massive difference that people are leaving on the table by, instead of picking and choosing, instead of either making their own financial plan or hiring someone to do it for them who knows what they're doing, they're choosing the default option. They're choosing to kick their feet back and watch Netflix instead of doing a little bit of education. So good for you for watching this and actually trying to educate yourself and learn more, and it will pay off big time. Because yes, maybe we did give up hundreds of thousands over the last 20 years, but that doesn't mean we need to over the next 20 years. Right? We can't do anything about how we have been invested. All we can do is change how we're going to be invested. And that's what we are hoping to inspire people to do. So obviously, this is not investment advice. You can't sue me if you do stuff and you mess it up. That's your problem. More disclosures in the description, I'm sure. But right, if you want someone else to be responsible for it and you want to be able to sue them, then you can hire them to do it. And if you do it yourself, then you're the only one to blame. So, okay. Awesome. So a couple other things. We'll do our stay the course sketch. Again, if you are not in our retire member, which is our totally free, lots of extra bonus stuff group, you can do that. I think there's a link in the description to become a retire member. I send out a weekly email. It's got a little memo and a sketch in it where we explain some stuff, and we're just repurposing some of those sketches on here. So nominal versus real return. So nominal return means just what did you get? I got 10%, I got 12, 8%, 4%, whatever else. Real return is your inflation adjusted return. What did you get after inflation? Right? And so if bonds are making 5% per year and inflation is 3, then your real return is 2. Right? If stocks are making 10%, equities are making 10%, and inflation is still 3%, then your real return is 7. Right? That track. And so here's what people get super wrong, right? Is they look at 5% and 10% and they say, oh, it's only twice as much. So I don't know if I want to go through all that volatility for twice as much money. I think you should, but some people think that. But here's the difference. Real return is all that matters, right? So your real return on bonds in this case is only 2, and your real return on stocks or on equities is 7. Right? So nominal return, you have 2x the return of equities over bonds. But real return, 7 to 2, that's 3.5 times the return. And so it's not that you just double your money investing in equities, being business owners of the best business in the world. You 3.5x it in real dollars. Right? And this is why I think a lot of people miss, and why they don't really contemplate exactly how much they're missing out by having too much of their money in target date funds and things that are getting 10%, or only 10% of their money being only making bond returns for their whole lives, is they don't realize that they are actually giving up a 3.5 times real multiple for a and instead of just a 2, right? It's literally 3.5 times more. And that amount over 10, 20, 30 years is just astronomical. And so part of my whole goal, right, is to help people. That's what we have this channel for. That's how I manage people's money in real life, is to help people become better investors, right? To be business owners in the best business in the world, and to stay the course, to be invested, stay invested, reap all these benefits, even during the scary times, even during the uncertain times. That's what we're here for. So that's a key difference. And if we don't understand that, then I think it's going to help us. We're going to keep leaving more on the table than we need to. Okay, and then lastly, we always do a question on this show. So if you have questions, you can put them in the comments below, and we will browse through and find those, or you can email questions@retirementorship.com. And I got one from Angie, I think. We want to throw that up there. What's the difference between all the companies that hold money? And so they'd elaborated a little bit, and she'd said, what about like Schwab and Fidelity and Empower and all these other things? Like, what are these places? How does this work? What's the difference between them? It was a great question. Like, have you done anything on this? And I said, no. I don't know if I have. So we'll do it now. Right. So you invest in. I think can we zoom this out, Ethan? I think it might be zoomed all the way in still. There we go. Perfect. You invest in, right, for the most part, mutual funds, ETFs, right? Those are collections of, and those are collections of, inside of mutual funds or ETFs, those are just bonds or equity funds or equities, right? It's like those are the actual things we invest in. But where all those things are held, right? What are the companies that actually hold mutual funds, that hold ETFs, that hold whatever else, right? And there's a whole bunch. The most common one that holds things are your custodian. Okay? These would be things like Charles Schwab. That's who we use primarily. Schwab, there we go. Charles Schwab, Fidelity, right? Pershing is another big one for other advisors. And then even things like Vanguard could be considered a custodian because they do have a brokerage platform that allows them to do Vanguard. There we go. So all these places actually hold your money. You log into these places. You can see your money in there. They're holding it. Maybe you've got IRAs. So right, mutual funds, ETFs, etc. Those are inside of either an IRA. I'll put this on the side. An IRA. Or a Roth, right? So you have the types of investments inside a type of account that's held at a custodian, right? And so you'd also have things like Empower, does a lot of 401ks, Principal, all these different things. Those are the ones that hold your money inside of it, right? Now, when you have a 401k, sometimes you interact directly with the custodian, like Fidelity holds your 401k and you just sign into Fidelity. Sometimes with 401ks, there is a third-party administrator, some other firm that you actually log into to do things, to submit requests, all that kind of stuff. But a lot of times, you just log in directly to the 401k. If you're working with an advisor, not only is there a custodian, but there's also a broker-dealer. And these are the people that allow advisors to sell commissionable products. And so what can happen with a lot of other advisors, right, is you have the broker-dealer and the custodian. So before I launched this firm that I currently work with, I worked for two other firms, and one was an insurance-based broker-dealer and one was an independent broker-dealer. And so it was, I'm not going to actually say because I don't want to get in trouble, but and those ones worked with Fidelity and Pershing. And so when I worked with, my broker-dealer, we'll say, I would interact with you, but then if we wanted to do something, I had to go through the broker-dealer to the custodian. I wasn't allowed to talk to Fidelity directly, and I wasn't allowed to talk to Pershing directly. They both have their own platforms and their own support staff and whatever else, but I had to go through the broker-dealers that I was affiliated with in order to do that. And so what often happens is broker-dealers are just this extra layer, this middleman in the middle that allows advisors to sell annuities and commissionable mutual funds and all this other stuff. But because they have their own whole layer of technology, of people, of support staff, it adds a whole extra layer of fees to this, right? Which is why generally we recommend that people work with no broker dealers, and if you want to work with someone, right, you can always try to do this on your own, and good luck to you if you do that. But try to work with what would be considered a registered investment advisor. And those are people that are registered directly with either the state or the federal government, like where if you get big enough, like we register directly with the federal government, with the SEC, the Securities and Exchange Commission. And they will work directly with the custodian and you. So there's no middleman. right? And so like our clients, they have all their money at Charles Schwab, and I can talk directly to Schwab. We log into Schwab ourselves. We manage their money there. We send them money back to their accounts there. It's all in one place. There's no more middleman that's just adding fees, adding complexity that we don't really need. Pershing only works with broker dealers, and so you're not really going to have access to them. And so you'd find a RA that has their stuff at Charles Schwab, Fidelity, Altruist is another big one that's coming up. That's a good one. Vanguard doesn't really work with custodians. Empower works mostly with 401ks. And so there's different pools of people, companies that do different things, but for the most part, custodians is where your money is actually held, and then it just depends on where do you need to go through to get there, right? So hopefully that's helpful. Again, if you're working with people, we generally recommend stay away from insurance companies in general, aka insurance-based broker dealers. And again, if you're ever curious, you can go onto an advisor's website, scroll all the way down to the bottom, and it will say somewhere on there, investment advisory services provided through X, and insurance and whatever is sold through Y. So you can find out who they're actually working for, because a lot of times they have like their own branding, but who they're working for is on the bottom. So hopefully that's helpful. And otherwise, that does it for today. Again, if you have questions, you can throw them in the comments. You can email them to us, and we look forward to seeing you next week. We're here every Wednesday, 4 p.m. Central. We do it live, and of course, you can always watch it after the fact on the YouTubes. So we'll hope to see you next week. Take care. Stay the course. Cheers.